Welcome. Thank you for joining us. My name is Bridget Young, and I'm part of the Alumni Engagement team. Thank you for joining us today. This session is being recorded. I just wanted you all to be aware of that, and we may take some screenshots of photos to use on social media as well. I'd like to take this opportunity to introduce PKE alumna Jeanette Nakandakari, who will kick us off today.
Thank you, Bridget. Good afternoon, everyone. And on behalf of the PKE Alumni Executive Planning Committee, I would like to welcome you to the PKE Faculty Speaker Series, Startups and Equity Allocation Concerns with John Scully. I would like to also thank the PKE Executive Planning Committee, Bill Barkowitz from PKE 139, Alan Goad from PKE 120, and Amy Towner from PKE 139. We welcome all of you, our PKE alumni, faculty, staff, current students, and prospective students and guests. In May of 2019, we had our first PKE Summit, and it was a huge success. Dean Van Rensburg and the PKE alumni president agreed that we should build upon the momentum, and the intentions for this year would have been another in-person event. And due to COVID, we quickly pivoted and decided that the Faculty Speaker Series would be a great way to build our network and for all of us to just stay connected until our in-person event. Now, the Graziadio PKE Alumni Network will invite you for one last session on August 19th, Business Strategies Q&A with Dr. Kurt Matomedy. So we welcome you to please register. It is currently open for registration. On special notes, another way to build your network and staying connected is by joining us on PKE, the PEP Connect. We have a PKE group where you can be notified on all PKE events and other informations. And you could also help PKE stay strong by recommending others to study at the Graziadio Business School. And our contact for PKE is Pearl Quintana. Her information is currently displayed. We also have extended the $2,500 referral scholarship, so please advise any prospective students in your network. And lastly, being part of our executive associates is another special way to invest in our alma mater. Now, without further ado, I am excited to introduce Dr. John Scully, CPA, practitioner, lecturer of accounting and finance at the business school. Dr. Scully's professional experience includes 25 years of finance, accounting, and auditing services for Fortune 500 firms, mid-sized companies, and startup organizations. He is the co-founder and board member of Ecliptics Enterprises, which provides tailored imaging and space avionics systems for rockets, missiles, and spacecrafts, including publicly recognized systems for NASA's Space Shuttle. He is also a recipient of the Howard White Award, which is the university's highest honor for teaching excellence for teachers who inspire, stimulate, challenge, and motivate their students. Welcome, Dr. John Scully.
Great. Thanks, Jeanette. I appreciate it. I thank everybody today for your time and all the folks that have worked on putting this event together today. Okay. Everybody seeing the screen okay? Great. Just a couple things by way of background I'm going to have a couple questions at the end, so everybody's going to have to do a little bit of work at the end. But along the way, if you have any questions, don't hesitate. If you could, though, maybe just either raise your hand or just notify the chat room. People will be monitoring that. But I'm going to recommend, rather than typing out a long question, then we'll just unmute and let the individual speak and ask your questions or whatever, and kind of go forward informally if that's okay with everybody. So with that, I'll go ahead and get started. The topic again is startup and equity allocation concerns, or often things don't matter until they do. And a lot of us in here, or maybe many of, I'm not sure how many, may have had the experience of working, especially with an early stage company. And the first time you do that, you get all excited, you got some stock options and all, and then not even really clear what they mean. What percentage of the company does it represent? What are the rules for exercising those options? And then the company goes bust 6 months later, and it didn't really matter all that much. And then some of us get cynical over time. You have more and more. Like originally, I'll tell you, the first time I got an outright stock grant from a company signing on board with them, actually, went and framed the stock certificate. So 6 months later, the stock was worthless. So, but a lot of us may have these options or shares of stock, in the drawer, collecting dust. But sometimes it does matter. Sometimes they do have value. So give me 1 second here. I'm not sure. Okay. Kind of an interesting development. At PKE 145 at the kickoff, myself and I know a number of people here, probably almost everybody, had Kurt Matomedy for the strategy class. Well, for the finance portion of the kickoff, I picked this case, a real short one, about 3 or 4 pages. How much is sweat equity worth? And interestingly enough, Kurt picked a new case for the kickoff as well. Uber board, the title is Uber board deliberates, is good governance worth the firing of an entrepreneurial founder? What was interesting is, although we did not plan this, both these cases seem to be deeply interconnected. Now, the Uber case, if you've ever read it, is somewhat complicated. There's a lot of issues in there. It's a fairly long case, whereas the sweat equity case is just real simple. But interestingly enough, and I say it was kind of fun because this was unplanned, a lot of the issues that really were rearing their head back in the early stages of this company in the sweat equity case really materialized when Uber was approaching their IPO. So this Uber was at once a very small company, very early stage company. Some of these issues weren't taken care of, and they reverberated all the way up to the point of the IPO. So again, the way to think about this, we're going to have 2 cases to keep in mind. We're going to have the sweat equity case, which is the early stage startup, and Uber. And I'll try to make clear at each point when we're talking about the sweat equity and when we're talking about Uber. In the sweat equity case, the situation is essentially like this. The founder started the company, and at some point in the past, he sold a 10% stake in the company to some investors. And he retained the other 90% for himself. Early on, his cousin quit a lucrative job and joined the company. And it's clear from the case that the cousin is a prime contributor, helping resolve issues with the product, really good with customers. And then all of a sudden, they're meeting with the accountants at the end of the year, and the accountants ask, what are the individual ownership stakes in the company for the founder and for this cousin? Well, and the cousin responds that he thought he was entitled to or was getting half of the founder's 90%. Took the founder by surprise. Okay. Now, the concern here is just for the context of the case, is that the cousin is truly viewed as a key employee. That if he leaves, it's going to be a real impact on the company. So now the founder's in the quandary. What does he do? He wants to keep his cousin happy, but does he really want to give up half of his 90% stake? Okay. And again, the case concludes by asking you, the individual, what would you do in this case? And we're actually going to come back to that question later on. Now, simplistically, it may seem simplistic, but it's a simple question. What percentage of the 90% should the founder give up? But is it really just an economic issue? The case couches is like it's an economic issue. How much of the value of the company is going to be retained? But referring to this Harvard Business Review article, just a short quote, founders are usually convinced that they can lead their startup, that only they can lead the startups to success. Quote, I'm the one with the vision and the desire to build a great company. I have to be the one running it. Now, why do we find this sort of tenacious nature of founders of wanting to keep control of their companies? Well, a little bit of history, this is just going back, and this is a piece also from the Harvard Review. And it says, because investors bear most of the risk if a startup fails, preferred shareholders, primarily early stage VCs, were given protective provisions, such as a right to block the sale of the company, and a majority of seats on the board. A startup required successive rounds of funding. As startups required successive rounds of funding, founders sold their ownership in the company, and with it, their control dwindled. Then over time, Silicon Valley filled up with people who had founded iconic firms, but spent the remainder of their careers telling woeful stories of how the VCs stole my company. And I just mentioned down the bottom, the classic case you still hear at times about the founding of Cisco and the venture capital people taking control of the firm. So the recognition is here, it's not just coming out of the blue that founders are concerned about controlling the company. There's a history of them having felt like they've lost the company. Okay. Now, what's happened and changed in recent years is that there's become more financing opportunities available for the entrepreneurs and for longer periods of time. Like, for example, rather than the old model was you have your startup, you get some angel investors, you bring in some VC funding. Next step is you got to get to an IPO. That's where everybody cashes in. But now we see more alternatives for developing relationships with strategic parties. Also, that investors are willing to stay involved and invested for a longer period of time. And now we have the case of so-called unicorns, the privately held companies really close still to the startup stage, valued at over $1 billion. And in recent years now, that number has grown, and a number of them far surpassed the $1 billion valuation. Now, what happens if the founder relinquishes half of his 90% to the cousin? Well, the first thing, he loses control. Now, it doesn't mean he won't have a lot of influence, but he's not now the sole decision maker for the company on the major decisions. And here's the other problem, that if he and his cousin have a falling out, they're both going to be appealing to the 10% investor to make the decisions to control the company. So again, at the end of this discussion, I'll be asking you what you would do in such a circumstance. But the risk is here, not just economic to the founder, but also that the control is going to be gone. And if you really believe that it was his motivation, his vision that's driving the company, this could kill the company at an early stage. And as we all know, there's a high probability of early stage companies failing anyway. Now, this control issue is often paramount to founders, even long after the early stage, or after the startup stage. For example, Mark Zuckerberg, as of the 2019 proxy statement, still controlled 53% of Facebook. And the quote attributed to Mark Zuckerberg, quote, "One of the things that I feel really lucky we have is the company structure where," and this is a direct quote, I know the sentence structure is a little awkward here, where at the end of the day, it is a controlled company. We are not at the whim of short-term shareholders. So in the case of Facebook, Mr. Zuckerberg believed that having, and it's him, he has the control, having control is a critical issue for the success of the company. Chartered financial analysts wrote a report on dual class shares. I'll explain what that is in a minute. But the CFAs, it's a prominent designation. Financial analysts, that's the main one they work for. So think about them as like a counterpart to a CPA license, difficult certification to achieve, but many people working in finance, that's sort of their goal, to get that CFA designation. And it's a worldwide organization. And they just pointing out that many entrepreneurs would simply choose not to take their companies public if they could not retain control. And then interestingly, this would deprive investors opportunities to invest in growth companies. So it's a recognition that with some founders, the control issue is worth more to them than the economic issue. Now, the second thing, though, which is kind of interesting here, is their comment almost makes it sound like people that are in leading growth organizations almost have a responsibility to take those companies public so the rest of us can invest in them. That seems a little strange. I'm not sure that the entrepreneur has that kind of an obligation to the general public. Now, we can understand why it's valuable for us as a society to have growing companies go public so all of us can invest in them. But I'm not sure it's an obligation of the founder. But this is a concern. As of 2019, the number of publicly traded companies has fallen 46% below the 1996 level. And we might think that's skewed by the .com stage, but even 16% below 1980. Now, recently there's been a change with the SPACs, but we also know now the SPACs are coming under scrutiny. So essentially, you and I do have fewer options in terms of how many publicly traded companies are available to us to invest in today versus people 20 years ago. And it does seem to be a significant concern. I'm just not sure it's a concern for the founder of a startup company. So now the question seems to be, is equity allocation really a one-sided or two-sided question? We started by asking, how should we split up that 90% held by the founder? But maybe it really becomes two-parted question. We have the economic interest about how the financial pie should be divided, and then we have control interest. Will all equity holders have same pro rata voting rights? Like, let me just scroll back up for a second. For example, Mark Zuckerberg, his Class B shares have 10x voting rights. So each one of his shares have 10 votes for every share that people buying, if you or I go out and buy Facebook shares on the stock exchange today. So we have, with the allocation of stock interest, we have economic interest, what part of the financial benefit will I get? But should we consider a different allocation on terms of control rights? And we'll talk about that in a second here. So the possible solution are these DCS or dual class shares. And that's where the shares, for example, I may have a share and let's say Amy Toder, who's here with us, Towner has a share. Well, we each have one half of the economic interest of the company, but we could have it so that Amy has many more voting rights associated with her shares than I have. So when we talk about this dual class share issue, it seems like three conditions are necessary to make it kind of interesting. One, the company has to have more than one class of stock. Shares of at least one of those classes of stock have superior voting rights than the other. And interestingly enough, that this disparity in voting rights is sufficient to get the holders with less than 50%, get them to majority control. So let's just kind of clarify where we are right now. We're there with the founder of the company dealing with the issue with his cousin, the worker, and he wants to keep control of the company. So let's say he's even willing to share the economic interest with his cousin. Is there a way, or should there be a way, for him to keep control of the company, whereas still allowing them to split economically on the same basis? So let's do a simple example, like what might happen now, talking in this simple case with the cousin, the founder and his cousin. So remember, the founder had 100%, sold off 10%. So does my cursor show up? Oh, okay, good. So here's where we are today. I'm just going to assume that there were 100 shares at this. Before the cousin issues come up, the founder has 90 shares, the cousin has 0, the investor has 10, 90%, 0%, and 10%. Clearly at this point, before the cousin starts raising concerns, the founder controls things with 90% of the vote. So now let's say if the founder said, okay, we'll go to the dual class shares. The founder will turn in some of his shares for new vote shares that'll have 1.5 voting rights per share. And presumably the investors would as well. The investor's not going to let the founder get more votes without wanting the same thing. So in this scenario is that if the founder gave half of his shares to his cousin, the economic rights would now be split 45 for the founder, 45 for the cousin, 10 for the investor. But now, if the founder and the investor shares have the 1.5x voting right, they would now have 45% of the economic interest. I'm sorry, this is the economic interest, this is the voting rights over here. 1.5 times their 45 economic rights means they would have 68%, 68 essentially votes. The cousin would still just have 45, and the investor would have 1.5 times the 10 or 15. So essentially, even though it's only 100% of the company, there would be a possibility of 128 votes being cast on an issue. The founder retains control here at 52.9%. The cousin would have 35.3%, and the investor 11.8%. Everybody kind of follow the scenario? So it's a way the founder can say, look, okay, cousin, I'm giving you half the economic rights, but I need to keep control. Okay. So that seems like it may be a way out, but it doesn't quite get us there, because you still have this issue that if the founder has control, sometimes founders can achieve things called private benefits. And private benefits is a term that can be used in a couple of different contexts. But in other words, he could still devise incentive systems, allocate contracts to related parties, et cetera. He's still going to be in control. The cousin, even though he may have an equal amount of, let's say they sell the company or in terms of dividends, there's still a backdoor way of the founder to get extra economic benefits if he's still in control. The other thing is that this probably isn't going to solve the issue for the founder, because pretty soon other people are going to want, the same kind of deal, or you're going to want to bring in new talent, et cetera. The founder is still going to have this issue of how is he going to control things, if he believes that control is essential to making the company successful. So that's sort of our theoretical discussion about the sweat equity case. Now let's go to the real world and look at what happened with Uber. Okay, so Uber was getting ready for their IPO, and they're concluding a deal with SoftBank, the Japanese firm. So in other words, the game plan was bring in additional investment from SoftBank in preparation for the IPO. At this time, Travis Kalanick, who was a former CEO of Uber, and others had blocks of shares that had 10x voting rights. And moreover, Kalanick had the ability to appoint individuals to 3 board seats. So he got a lot of control based on deals that were cut at some point in the past. Somehow, and this is a little mysterious about what happened, the board voted to, the first part's not too mysterious, to increase the number of board seats from 11 to 17, but also voted to limit the voting rights of all classes of stock to just 1 vote per share, which is interesting because the deal was issued in the past and these Class B common shares were issued with 10x voting rights. But now, coming up to the IPO of 2017, it's like they're saying, we want to change the ground rules here. Just as a matter of fact, SoftBank ended up purchasing shares held by the existing stockholders, including 1/3 of Kalanick's 10% ownership. They also invested another 1.25 billion to buy new shares, and they ended up with about 15%. So that's just kind of history. That's just what happened. But let's get back into what about this deal with these Class B shares with its 10x voting right. 2 early investors threatened to sue, and they threatened to sue individuals on the board. They didn't threaten to sue Uber. And again, I'm not an attorney here, so whether or not this is something you can do or not do, I don't know. But they threatened to sue them. And that what they maintained was that the board action that was being considered was a culmination of a blatant bait and switch, essentially robbing loyal employees, including the more than 200 early founding employees and advisors, of their hard-earned shareholder rights worth billions of dollars. In a letter from their attorney from these 2 investors, they said a key feature of Class B common stock, and hence its enhanced monetary value in the event of an IPO, is that the stock carries with it superior voting rights. You've been with Uber from the beginning and know better than anyone else how important these voting rights are and were in attracting Uber investors, as well as top talent. I did ask an attorney to do some research for me. He was unable to find that this suit was any outcome to the suit or even whether or not the suit was actually filed. But this was a correspondence from their attorney published in the Wall Street Journal. Okay. Now, if you remember back to around 2017, there was a fair amount of scandal going on, different things going on within Uber about employee behavior, et cetera. And needless to say, that was a significant issue going inside the company. But what was unclear when you go to the restated certificate of incorporation, which is just another way of describing the articles of incorporation, does describe conditions in which the Class B shares with the 10x voting rights get their voting rights reduced. However, there was not any mention of a situation like this. For example, sometimes the articles of incorporation will say that in the event of a company, an event to go public, these sorts of conversions will take place, or these sorts of exchanges will take place. There was nothing like that, at least that I was able to find in the articles in the certificate of incorporation. So now, just to claim that these shares with additional voting rights are more valuable. Revenue ruling 5960, which you may recall is a landmark ruling by the IRS relating to how do you value the shares of privately held companies. And one of the key points they mentioned there is if the corporation has more than one class of stock outstanding, the charter or certificate of incorporation should be examined as to determine whether explicit rights and privileges of various of stock issues, including voting power, preferences to dividends, et cetera. In other words, when it comes to valuation before the IRS, they're saying if there's two classes of stock and one has superior voting rights and one doesn't, you can't just say that the one without the superior voting rights has the same value as the one with superior voting rights. In other words, it's supporting the argument here that you can't just say, hey, I'm taking away your superior voting rights and don't worry about it. It's just a voting rights issue. No, this seems to suggest that there really is an economic basis for saying that if you take away those voting rights, you really have taken away some of the value that was being associated or owned by those stockholders of the shares of the superior voting rights. Okay. I won't go into this one. It's just another quote by talking about if you have control that the shares with control may have more value. Okay. So this again, the CFA Chartered Financial Analysts say they argue that there's three problems inherently wrong with these dual class voting structures. They say there's insufficient or absence of minority investor protection. And I think that some minority investors would say that. Skewed proportionality of ownership, skews between the ownership and the control, the economic interest versus control, and that leads to a race to the bottom in terms of corporate governance. And let me just check our time. I just want to hit on a couple of these issues real quickly. Is it the case that there may be insufficient or absence of minority investor protection? Yes. If all shares have the same voting rights, you may say we're being treated equally. And that if somebody has a small block of stock, but essentially still controls the company, well, am I really going to be protected because the other party is going to be in control? There's a couple of quotes here I'll be reading there was a conference held at the University of Delaware, particularly on this topic of dual class shares. And generally, they were pretty much condemned having a dual class structure. The titles that I use here are the titles that people had at the time of that conference. I know some people have changed roles, et cetera. But this one gentleman, Scott Goebel, talks about, well, if you have these differences in voting rights, then some stockholders, like the people that buy stock in companies with dual class shares, really are just, and you use the phrase, along for the ride because they're never going to have control. And that may be true, but at least from my perspective, though, yes, we have Facebook, we have Constellation Brands, Peloton, and all with these dual class shares. But the fact of the matter is that when most of us buy stock in a company, we know we're never going to get control, right? If I go out and buy 100 shares of General Motors could care less what I think about the company or the people that run it. It's just not going to happen. Or similarly, if you're an employee in a company and you get a stock option grant, unless you're one of the founders or really a key individual, chances are even when you exercise those shares, you're not going to have a lot of influence. So just to say that, hey, dual class share companies are bad, because what it means is that people without the superior voting rights are just along for the ride. True, but most of us are just along for the ride anyway, as a matter of fact, when we invest in companies. Now, again, that's not to say that dual class share stock companies are good. All it's saying is that, as a matter of fact, it doesn't seem enough to my perspective to say that it should be outlawed and say we shouldn't have these things. This one is the second concern they raise. And again, I'm just going to move a little quickly here because of time. They talk about it skews the difference between proportionality of ownership and proportionality of control. To me, all that is stating the problem. I mean, that's to say that there's that disproportionate nature is just true. It doesn't tell us what the problem is. And the third one, though, is they're concerned about the race to the bottom. They say the board, practically speaking, becomes much less a monitor. Instead, what you're doing is exporting or monitoring the monitoring function to third parties, to the government, the courts, the regulators, and then that creates a significant public cost. Well, that may be true, right? Because if a small group of people or one individual controls the votes, they're going to control the board, right? But that happens in a lot of companies anyway, where you have an individual or a family that controls the votes, right? And that if you have bad governance, you're going to have a race to the bottom, that it's not something unique to a company with dual class shares. So I just want to talk about this walkaway alternative. This individual, Ann Yerger, says, that is, yes, you could say that it's just an economic issue here. But again, it almost sounds like, the company shouldn't be issuing stock or selling stock where with this walkaway issue. You can, if you don't like the corporate structure or you don't like the family that controls the business, you can walk away. And I guess what troubles me is I'm not sure why the walkaway is considered such a bad alternative, because if I go to buy 100 shares of stock in a publicly traded company tomorrow morning, I'm not going to have influence. I'm not going to make an impact on them. And my choice is either to buy them or not, and recognize, yes, I have 100 votes, but chances are it's not going to be enough to make a difference. And then just a comment here about, and we're going to send out the slides afterwards so that everybody can have these and with all the references. It sounds like, again, too, that, it's a concern about the people that are late stage investors, right, showing up, and that they shouldn't be in this choice of, being involved or buying and staying in or just walking away. But there is a lot, I know a number of people in here have been involved with early stage companies. You're the ones that were there at night. You're the ones that didn't go to your child's t-ball game. You're the one that were, sitting in an airport away on special weekends for your family. There is a difference. And if you negotiate with the company up front that you should have extra rights, or you do think that you should get certain benefits, I'm not sure that we see the motivation yet why late arrivers should have the authority to force you to unwind those positions, right? Because presumably between you and that company at some point in the past, there was an event where you made an exchange to stay there and work. Maybe you were the key person, the key scientist, the key programmer for Uber, and you could have gone elsewhere. Well, why did you stay? And then to say that the people showing up years later should have the ability, not to say that, and again, what we're saying here is it's fine if the individual negotiates with the company to unwind the position, get, quid pro quo is one thing. To me anyway, it's a different thing to have the board decide to take back those rights from certain employees or shareholders. I won't go through all this again because I knew we've got to watch our time a little bit, But essentially, Mary Jo White, who was the head of the SEC, was raising concerns about these unicorn companies and saying that, now we've got these huge valuations that traditionally did not reside in privately held businesses, that tended to be the province of publicly traded companies. And then what she says down here is we have keen interest in ensuring that all applicable rules and regulations are followed, and that the pressures that shape these markets, meaning the private markets, do not lead to fraud or harm investors. Perfectly legitimate. But now she's saying we will provide, meaning the SEC, the appropriately regulatory oversight to protect investors so they can have confidence in continuing to support the marvelous technologies for which this valley, meaning Silicon Valley, is famous. So in other words, what she's advocating here is a broader role for the SEC to get involved with these early stage companies and the financing of them, in addition to the work with the publicly traded companies. I'm going to just slide through this one. Just talks about how there is a lot more capital going into these companies and staying private longer. But they do mention this part here that concern about losing out on deals. The stream of capital flowing into tech startups makes it harder for investors to pursue tougher governance provisions, lest they lose out on deals. Well, you know what? If you take the people that generally are investing in these privately held companies early stages, again, they're not on exchanges. It typically takes accredited investors to do this. People involved with VCs tend to be among the wealthiest and most sophisticated people on the planet. Do they need the attention of the SEC involved in there when they have the best resources, the best accountants, the best financial analysts? Is that where we need to have the SEC spending their time? Or perhaps should the SEC be spending their time? Why aren't there more publicly traded companies? Why is it that entrepreneurs shy away from becoming publicly traded companies? Okay. Just a couple of quick comments here. The UK, interestingly enough, this is November 2020, said Thursday, meaning back then, it will review rules around initial public offerings as it looks to make post-Brexit Britain more appealing to tech founders. This review includes measures that would give founders more influence over the companies upon listing, including the allowance of dual-class shares that give some shareholders, notably founders, more voting rights. So the UK is actually talking about opening up, becoming more liberal in a sense of allowing, voting structures, more diversification of voting structures. The New York Stock Exchange allows companies to list with dual-class voting shares, but once they're listed, companies could not reduce the rights of the existing shares or issue new classes with superior shares. Essentially what they're saying, if you come in with dual classes shares, you can keep them, but you can't introduce new ones. And I gave the references down here. The NASDAQ has a whole list of complicated rules about whether or not you can be listed with them with dual class shares. So now what do people suggest we should do? The CFA says that they propose that there should be a mandatory time-based sunset. In other words, that if a company does have dual class shares, that the exchanges, the stock exchanges, should force them to be unwound, and they're saying preferably no more than 5 years. My question would be, why 5 years? Why unwind them at all? Okay, because the deal was made in the past, okay? But here what they're saying is that regardless of the deal that individuals and investors made with companies in the past, they want the exchanges to unwind them in 5 years. Okay? They also propose event-based sunsets. Superior voting rights should lapse if holders no longer serve as a director, die, or become incapacitated or transfer shares to another person. Interestingly enough, the Uber certificate of incorporation does include some sunset provisions. It talked particularly about types of transfers that could not be done, but did not include anything there to say that they had to give up the 10x voting rights. So again, the time, in my opinion, would be is when the deal takes place, Uber could have negotiated with Kalanick and others with these Class B shares and said, hey, they are going to unwind under these additional circumstances, or they are going to unwind in 5 years, or they're going to unwind in 10 years. But they didn't do that. And let me jump ahead a little bit here. See, we have talked about, how the founder and his cousin were going to split things up. Then we thought, well, maybe there's two things. There's economic interest and there's voting interest. But now I actually come full circle. It's really an economic issue that, hey, if you want the person to unwind, then give them something, pay them for it. Or 10 years ago, when you asked that person to work, travel 6 months a year from home, work all night, instead of giving him or her shares with 10x voting rights, that was a time to say, we're going to give you a bonus. Or if we hit certain milestones, this will happen. They didn't do it. They gave them the voting rights. And to me, you can kind of sense my opinion on this. This after the fact unwinding seems off base. It was an economic deal. Somehow they got Mr. Kalanick and others to stay and work and do all these things. What they offered them were these Class B shares with 10x voting rights. They could have offered other things.
Dr. Scully, it's 12:40, just to let you know.
Okay, great. Let me roll forward here real fast. Some other things they say, enhance corporate governance. Okay, what is that now? Who knows? Limit voting right differential to below 10 votes per share. How did they come up with that? Why? What's wrong with 11? What's wrong with 10? Why is 9 okay? And revert to a one share, one vote system when we related party transaction. Again, my position would be negotiate that up front, not require the exchanges afterwards to unwind these transactions. So here we go. Now the fun part. A couple of questions. Just to get your opinion. Nicole, can you bring up the polling question? This is just my sort of longer version of it. So given limited resources, what's your preference for the SEC to focus on? Explore why the number of publicly traded companies has decreased and what, if any, is the resulting adverse impact to the investing public? Would you prefer to see their energy spent there, or would you rather see them going, and I'll phrase this a little cynically here, working and being engaged with the most sophisticated investors in the world in regulating these private markets and what can be offered to a greater extent? So just quick opinion about which of these you pretty clear probably where my opinion is, but just curious about where your opinion is in terms of the where you would like to see the SEC spend their energy. Watch, everybody will show me that I'm off base completely here. Okay. Nicole, do you want to see how we did?
Yes, are you able to see the results there?
I am not seeing them.
Okay, let me share the results. How about now?
Okay. Okay, so about 80-20, and I will fully admit that I probably skewed some of the conversation there with my biases on the question. Great, okay, interesting. Great, so can you close that one out, Nicole? Let's go to the next question real quick. Oh, I guess I'm still in control here. Okay. In the case of Uber, I'm asking you to assume you are on the board of Uber today. At the time that let's say at the time they're talking about going public. Would you side on forcing and assuming it could be done legally, I'm going to make that assumption, to force the unwinding of the 10x voting rights? Or would you walk away and saying, hey, Uber had made a deal with these people, we stand by the deal, even if it means we lose the deal with SoftBank? Kind of clear? Okay. How do we do, Nicole? How about an even split? Interesting. Good. So let me go to the third question, and then we'll come back and pull this one in as well. Third one's a little bit of a food for thought. Let's jump back in time, assuming you are the founder of the sweat equity case. Again, just a reminder, you've got 90% of the votes. Outside investor has 10%. Your cousin thinks he's an equal partner to you. You may lose control if you give him half, or maybe you consider the doing something with superior voting rights. So I guess I'd like to open it up, and again, too, at this point, maybe Nicole, just for time, we'll just let people unmute. And what do you do if you were that case? Imagine you're the founder. You came up with this company, you came up with the idea, you started it up, and now you're faced with the possibility of losing control. How do you, and presumably the assumption is you don't want to lose your cousin either. How about some opinions? Okay, Bill?
Yeah, I think the DCS solution is perfect in this case because chances are the cousin's really concerned about the work that he's put in and wanting the financial benefit of it, probably less so about the control. That would be my opinion. And he's probably, if they went with a DCS type solution, he's probably going to get a higher financial benefit out of it, because if you had to give your cousin a cut of the normal, standard shares, you're probably going to negotiate it to be a lot less so you can maintain the voting rights. So it makes a lot of sense to me.
Okay, so hopefully you can give him some additional economic benefits and you keep control for the company.
Yeah, and they should never be unwound, in my opinion.
Never be unwound. Okay, good. So we've got that as well. Okay. All right, let me say, and I presume, Bill, you mean by that forced unwinding should be a negotiated issue.
Correct, yeah.
Right.
Yeah.
Okay. Great. How about some other opinions? Okay, William, how you doing? Good to see you.
Yeah, great to see you, Professor. I agree that DCS is a good option, but there's a real leadership issue if this event was allowed to manifest. How does my cousin come on board and assume that he has 50% of my shares without any clarity coming from, like there's a real gap in leadership to even allow that event to transpire, which makes me nervous as the 10% investor and the cousins. So there's some other issues taking place. So DCS is an option. Renegotiating and getting clarity as we move forward is also really critical. But I'm fascinated to find out that my cousin, without anything in writing or clear communication, assumes he gets 50% of my stock. There's a real issue happening there.
Right. There's some deeper issues there. Yeah, and it's interesting that may actually the stock issue may just be symptomatic of a real big problem. But remember the challenge of, remember that you're in that startup, you're just trying to keep the lights on, and all these issues start popping up. And my hunch, and I have certainly no insights on Uber, but as fast as they grew and all the issues going on, in hindsight, I bet they wish they went back and thought about some of these issues, like in more detail about voting rights and all. But it's tough when you're just fighting to survive. How do you handle these issues? But you are right that this is probably symptomatic of, a leadership issue. Maybe this was the right person to start the company, who had the idea, but sometimes maybe that's not the right person to be managing it, once you start hiring people. How about any other thoughts on this with the dual class shares? The only thing I will say, I worked at a company once back years ago with Weston Engineering, and the family had a class of stock which had superior voting rights, and things. They were a company that went up on a curve, sort of hit a market at the right time, and things curtailed, but they got an exit opportunity, and it was not very amiable when, even though there were not tell any tales out of school, but there were people that had bought a good bit of the publicly traded stock and had the normal voting rights, who weren't happy about the way that evolved and all. So I know we always the focus in a business is thinking about the day-to-day, keeping the lights on, keeping things running. But on the other hand, if these issues aren't fully addressed, it can end up being messy, as it did in the case of Uber, a little bit in the case of this company that I work for, not nearly as complicated as the Uber situation. But even here, like, the first year of this startup company here, it got to be a complicated issue. Any other thoughts, opinions about them? Let's spend a minute then thinking about I was a little surprised by how close the vote was on the second question. And I'd appreciate maybe some perspective on, because again, it was about a 50-50 split. An individual too that thought that maybe the SEC should be paying greater attention to these private transactions. Anybody want to share any thoughts on that? And maybe this will help a little. Let me just go back here because I went through this a little quickly. This was, sorry, from the SEC chair noting this is part of the reason why she was concerned about this issue. And I was kind of startled by this statistic here. While the common refrain is that 9 out of 10 startups fail, an equally interesting statistic from one post-mortem analysis, and she didn't cite the reference, is that 70% of failed startups die within 20 months after their last financing, having raised an average of $11 million. In other words, I think what she's saying here is that these aren't the folks that are just friends and family early on. This is pretty significant money, and that raising an average of $11 million, and 70% of them fail within 20 months. So it's not just that raw statistic on failures. This is when companies are raising significant amount of monies and they're failing, and that maybe maybe there isn't governance issues there. But I think when she's raising the red flag, maybe somebody needs to go, namely the SEC, go in and take a good look at this issue, given these types of statistics. So anybody want to share any thoughts about their feelings on leaning towards a stronger SEC role? Don't be shy. Bill's a no. Sandy, is that a yes?
Yes, I have some thoughts.
Great.
Well, I do have many clients that have dealt with the SEC and their public companies, and if they had to do it all over again because of the regulations and the reporting and all the chokeholding that the SEC does, although sometimes good and sometimes restrictive, they wouldn't do it again. But with regard to kind of the failure rate here, going back to the DCS rule, I was thinking, because as a company grows, the talent, the resources and so forth would need to, migrate and be fluid as well. So maybe there is some kind of, if it hits a threshold, there's payouts and there's ways to compensate the then very valuable talent. But as the needs of the company grow, it has the flexibility and those resources to continue to have, new ways to get in new talent and new investors.
That's a good point, because I think, Sandy, because clearly Uber at the point of this IPO is a very different company than it was 5 years ago, 5 years before that. And maybe there needs to be that flexibility, but I would agree with you 100%. I think you hit on a key point, maybe said it much more articulately than I did. It's the compensation. If you're giving something up, there should be a quid pro quo, and maybe it's more if it's forced. If it's going to be forced liquidation or forced surrendering of rights. Good.
Right, and if they meet certain thresholds to make that move to improve the business and improve the value of that company, then they have something that benefits them as well, but it doesn't restrain the company from growing, because I think at some point they get in, they're macerating in their own challenges and they don't move forward.
And with this, and I will turn it back over to Bridget here in a moment, but this and it works both ways. think about, and we probably know directly or indirectly, individuals who've had startups, and to get investors had to give up very valuable rights, because maybe they were at that desperate moment. They needed to make payroll this week or it was over, and gave up a lot to get the cash to do that. And, and then, if you give up, let's say, preferences, liquidation preferences, which can be very onerous, that will haunt the company forever, that it does seem like, it'd be nice if there were, on the other side as well, opportunities to unwind for the entrepreneur as well, and the founder. Great. Well, I really appreciate everybody's time today and attention. It's kind of interesting, and say this was interesting to me just because Kurt and myself picking cases in isolation, and yet it really seemed to be along a spectrum that this was the sweat equity was just sort of a microcosm of what eventually happened out of here in Uber. And needless to say, became a real challenge where billions of dollars were at stake and not small dollars, when trying to decide, when Uber was approaching that IPO, key issue was who was going to get what and why. So, well, I thank everybody very much. I appreciate your attention and giving up your time to be here. It's great to see everybody. I hope everybody's doing well, enjoying life after graduation and all. And I hope we'll have chances to catch up soon. And with that, Bridget, I'll turn it back over to you.
Thank you so much, Dr. Scully. We really appreciate your time and expertise and informing us and keeping us updated over Zoom. So we appreciate these new ways to connect with our faculty and our alumni. As a member of the alumni engagement team, we value your feedback, our PKE alumni. So if you could take a moment to fill out the event survey here, it helps us with continuing programming just for our PKE alumni. I'd also like to take the chance to thank our executive planning committee. They're volunteers and they really spearhead our PKE community. So if you'd like to get involved more, please let us know. We are looking to host a PKE summit in 2022. So our next event is August 19th, Business Strategy Q&A with Dr. Kurt Matomedy. Please encourage your cohort to attend. We really, really want to encourage attendance. I have put the registration as well as a networking form in the chat again. So we encourage you, again, if you want to network with people who are on this call, please fill out that optional networking form. It kind of opts you in to share your LinkedIn address with one another. So thank you again for attending and have a lovely afternoon, and we hope to see you in August.
Great to see everybody. Take care.